Do you think your Social Security is truly yours? The truth is, if you make certain hidden mistakes, the IRS could take up to 85% of your Social Security benefits through taxes, not 10%, not 20%, 85%. That is money you spent your entire working life paying into, money that was supposed to be yours in retirement, money that millions of seniors are losing every single year, not because they broke any law, but because they did not know where the hidden limits were. As an enrolled agent, someone who is federally licensed to represent taxpayers before the IRS, I have seen this happen to retirees at every income level. People who did everything right, people who saved diligently, filed their taxes honestly, and still walked into retirement, giving far more to the IRS than they ever needed to. Today, I am going to show you the traps every retiree should know about, the hidden income limits that trigger Social Security taxation, the mistakes that push you into the 85% zone, and the steps you can take right now to legally reduce or eliminate the tax on your Social Security benefits. Stay with me. This one could save you thousands of dollars every single year for the rest of your retirement. Now you are probably wondering, how is it possible that Social Security, a benefit I paid into for 40 years, can be taxed at all? And more importantly, how do I find out if I am in the danger zone right now? Let me walk you through exactly how this works, starting with the rule that almost nobody fully understands. The first trap is called provisional income, and it is the foundation of everything we are going to talk about today. What it is and how it works. Provisional income is not a term most people have ever heard. It is not on your pay stub. It is not something your employer reports. But the IRS uses it every single year to determine how much of your Social Security is subject to federal income tax. Here is the simple definition. Provisional income equals your adjusted gross income. That is your total income minus certain deductions, plus any tax-exempt interest you earned, plus 50% of your annual Social Security benefit. That last part is critical. Half of your Social Security benefit counts toward your provisional income, even before the IRS decides how much is taxable. Now here is where the hidden limits come in. There are two thresholds that determine how much of your Social Security gets taxed. Threshold number 1, the lower limit. If you are single and your provisional income is below $25,000, 0% of your Social Security is taxable. None of it. If you are married filing jointly and your provisional income is below $32,000, same result, 0% taxable. Threshold number 2, the middle zone. If your provisional income falls between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple, up to 50% of your Social Security becomes taxable income. And threshold number 3, the danger zone. If your provisional income goes above $34,000 as a single person, or above $44,000 as a married couple, up to 85% of your Social Security is subject to federal income tax. 85 cents of every dollar of benefits you spent 40 years earning added to your taxable income. Why this trap is so dangerous? Here is the part that makes this genuinely dangerous for so many retirees. These thresholds have not been adjusted for inflation since 1983 and 1993, respectively. Think about what that means. In 1983, a single retiree earning $25,000 was considered a relatively comfortable income. Today, with decades of inflation, $25,000 barely covers basic living expenses in most parts of the country, which means millions of seniors who would have been completely below the threshold in past decades are now sitting in the 50 or 85% zone, simply because their modest income has not kept up with rising costs while the thresholds have stayed completely frozen. The trap was not designed for you, but because the thresholds never moved, you are in it anyway. How to check if you are in the danger zone. Here is how to calculate your own provisional income right now, in 3 simple steps. Step 1. Take your adjusted gross income from last year's tax return. That is the number on line 11 of your Form 1040. Step 2. Add any tax-exempt interest income you received, typically from municipal bonds. This is on line 2A of your 1040. Step 3. Add 50% of the total Social Security benefits you received last year. That number is on your SSA-1099 Form DA, Box 5 by, divided by 2. Add those 3 numbers together. That is your provisional income, Compare it to the thresholds I just gave you, and you will know exactly where you stand right now. Please note, this video is for educational and informational purposes only. It is not tax advice specific to your personal situation. Every retiree's income picture is different. Before making any decisions based on your provisional income calculation, please speak with a qualified tax professional or an enrolled agent who can review your complete financial picture. Trap number 2. And this one is the most common mistake I see retirees make, especially in the first years of retirement when they are adjusting to living on a fixed income. What it is and how it works. Traditional IRA and 401k withdrawals count as ordinary income in the year you take them. Every dollar you pull out of a traditional retirement account goes directly onto your tax return as taxable income. Now here is why that is dangerous in the context of Social Security taxation. Remember provisional income. Every dollar of IRA withdrawal increases your adjusted gross income, which increases your provisional income, which can push you from the 0% zone into the 50% zone, or from the 50% zone into the 85% zone. It is what tax professionals call the torpedo effect. You take out an extra $10,000 from your IRA, maybe to cover an unexpected expense, maybe to help a family member, and that $10,000 does not just cost you the income tax on $10,000, it also makes more of your Social Security taxable. So the true cost of that $10,000 withdrawal might actually be $15,000 or more when you factor in the additional Social Security that becomes taxable because of it. Why this trap hits seniors hardest. Here is the specific scenario I see most often. A retiree is living on Social Security and a small amount of savings. Their provisional income is right at the edge, say $23,000 as a single filer, $2,000 below the first threshold. Then their furnace breaks, or their car needs repairs, or a medical bill arrives. They pull $8,000 from their IRA to cover it. Completely reasonable. But now their provisional income is $31,000. They have crossed the $25,000 threshold. 50% of their Social Security is now taxable income. That one withdrawal, made out of necessity, triggered a tax bill they did not expect and could not easily afford. How to protect yourself from this trap? The solution is planning, specifically, understanding your provisional income number before you take any IRA withdrawal. Before you withdraw from a traditional IRA, calculate where that withdrawal will put your provisional income. If the withdrawal will keep you below the first threshold, you are in the safe zone. If it will push you into or through a threshold, consider alternatives. Could you take a smaller amount? Could you spread the withdrawal over 2 calendar years? Could you use money from a Roth IRA instead, which does not count toward provisional income at all? Even small adjustments in how and when you withdraw can mean the difference between 0% and 50% taxation on your Social Security. The strategies I just described, such as Roth withdrawals and spreading distributions across tax years, should always be reviewed with a qualified tax professional before implementation. Every situation is different, and individual results will vary based on your complete income picture. This is informational content only, not personalized tax advice. Trap number 3. And this one surprises people because it involves money that most retirees do not even think of as income. What it is and how it works. Investment income, dividends, capital gains distributions, and interest from savings accounts and CDs all counts toward your adjusted gross income. And here is the trap. Even tax-exempt interest, the kind you earn from municipal bonds, counts toward your provisional income calculation. I said that earlier, but I want to make sure it lands. You specifically chose a tax-exempt investment to avoid income tax. And the IRS still uses that income to determine how much of your Social Security is taxable. That is not a mistake. That is the rule, and it catches retirees off guard constantly. Real example. Here is a scenario I have seen play out many times. A retired couple has $32,000 in provisional income, right at their threshold. Their Social Security is at 0% taxation. Then they move some savings into a CD that pays $3,000 in interest. Their provisional income goes to $35,000. They cross into the 50% zone. The $3,000 in CD interest now costs them far more than $3,000 because it has also made a portion of their Social Security taxable. The CD interest effectively triggered a tax on their Social Security that was larger than the CD interest itself. How to protect yourself. This trap requires looking at your entire income picture together, not in separate pieces. Before you open a new CD, a savings account, or any investment that generates income, calculate where that income will put your provisional income number. If you are close to a threshold, even a small amount of additional investment income could push you over. In some cases, moving savings to a Roth IRA, a health savings account, or simply delaying the recognition of certain income to a future year can keep your provisional income below a critical threshold. The goal is not to avoid earning income. The goal is to understand which income triggers the most damage, and to make smarter choices about how you structure your retirement finances. Restructuring your investments to manage provisional income is a strategy that requires careful analysis of your complete financial picture. I strongly encourage you to speak with a certified financial planner or an enrolled agent before making any changes to your investment accounts. This content is educational only, not a substitute for professional advice tailored to your specific situation. Now I want to give you 3 legal tools that can reduce or eliminate Social Security taxation, because knowing the traps is only half the answer. Legal solution number 1, the Roth conversion. Moving money from a traditional IRA to a Roth IRA in your low-income years reduces future IRA distributions, which reduces future provisional income, which keeps more of your Social Security tax-free. Legal solution number 2, the qualified charitable distribution. If you are 70 and a half or older and have a traditional IRA, you can donate up to $18,000 per year directly from your IRA to a qualified charity. That money never shows up as income. It satisfies your required minimum distribution, and it lowers your provisional income by the full amount of the donation. Legal solution number 3, timing your withdrawals. In years when your provisional income is low, take larger IRA withdrawals. In years when it is higher, take smaller ones or draw from Roth accounts instead. Managing the timing of your income across different years in retirement is one of the most powerful tools available to any retiree, and it costs nothing, except the knowledge of how to do it. So let me leave you with this. Social Security taxation is not random. It is not arbitrary. It follows specific rules with specific thresholds. Thresholds that have not changed in decades while inflation has pushed more and more seniors into the taxable zone. You now know what provisional income is. You now know the 3 thresholds. You now know the 3 traps that push retirees into the 85% danger zone without warning. And you now know 3 legal tools to fight back. Knowledge is the only thing that separates the retirees who give 85% of their Social Security to the IRS from the ones who keep most of it. Now I want to ask you to do one thing. Hit the subscribe button below this video and tap the bell icon right next to it. Because next week I am coming back with a topic that affects every retiree who receives pension income. Most people assume their pension is straightforward. A check comes in, taxes come out. End of story. But there is a calculation the IRS uses to determine how much of your pension is taxable, and most retirees are overpaying because nobody ever explained it to them. That video is coming next week. Subscribe right now so you do not miss it. And before you go, please send this video to one person over 65 in your life, a parent, a sibling, a neighbor, a friend from church. The odds are very good that they are in the danger zone right now and have no idea. One share from you today could protect their Social Security for the rest of their retirement. I will see you in the next one.